Let's bring it all in with Seema Shah, Principal Global Advisors, Chief Strategist. And Seema, are you in that camp, given that we've had a lot of calls that peak growth is behind us?
Yeah, we are. We're definitely of the view that interest rate hikes are much further out, certainly even what the market is maybe thinking. We're thinking mid-2023, potentially even later, if you just don't get that, if you don't get the return to labour supply that the Fed is looking for. I do have a disagree with Stephen there about the rate, about where treasuries are going to go. We do think they're going to go a little bit higher. Term premium has been strangely behaving in the last couple of months, and we are looking for that to turn around.
What does that mean for stocks? Rates higher, sell stocks?
No, we actually think that, look, when you're going to get those rates higher, they're going to be moving at a gradual pace. We're not looking at ridiculous levels. We're looking at the kind of 160, 170 levels. And that's going to be against a backdrop of still strong growth. We do think earnings will continue to perform well. So those are still good foundations for equities. But importantly, look, valuations are high. We're not going to see the same kind of movement from fiscal stimulus, the same kind of boost from vaccination. So you really need to see earnings recovery coming through, or earnings growth coming through. So as long as we have that, then we think equities can continue to perform well.
Interesting. You said that the bond market has been behaving strangely. Is this a lot of technicals and not so much fundamentals that keeps us very much anchored around a 135?
I think so. I think the last couple of months we have seen those technical indicators that really start to turn on their head a little bit. And we are hoping, or we've even started to see in the last 2 or 3 weeks, that some of that is turning around. Now, I think what's definitely true, though, is, at the early part of the year, the forecasts were around the kind of the 190 level, the 2% level for US Treasuries. Those have come down. And I think that's a mix of maybe some of the technical indicators are going to continue to persist, but also the fundamental growth outlook for the US has come down a little bit for the second half of the year, too.
OK, let's dig into this a little bit more. You talked about the earnings narrative there, which you say is important in terms of keeping equities kind of on the tracks. As you also say that we're starting to see maybe a little bit of a growth slowdown. What we are certainly seeing is input costs, both labour and materials, rising for businesses. Now, the indications thus far, and you can see this in the gap between CPI and PPI, is that companies are absorbing that in the middle of the P&L, i.e. margins are being squeezed. At some point, Seema, that's going to have to show up in the earnings season. Is it the next earnings season? Is the earnings season after that? And is that impact priced? Because at the moment, the expectation is that equities continue to clear relatively low earnings bars.
Yeah, I think that what we did see is, at least with Q2 earnings season, the focus wasn't really on the results. They were really focusing on that guidance to see if their margins were really being pressured and what we could gauge about the outlook going forward. Now, I think what we are hopeful for is some of those input price pressures should start to ease early next year. And for the time being, that should mean that companies should continue. But I completely agree. That is a key focus for investors going forward. And if you do start to see companies really being pressured on their margin side, and it starts to weigh on their earnings delivery, then of course the view has to change in the equity market. But at this stage, with a solid growth outlook, I think they can withstand some of those pressures from input prices.
How are you positioning to take advantage of companies who have the pricing power to pass those costs on to the consumer versus those companies who may not have that pricing power?
Well, I think it's key right now is, you have to know which companies you're looking at. It's not enough to think about stars, growth versus value. You have to be looking at what are those companies' balance sheets, what are their growth rates, and where is the pricing power coming from? So although we are, of course, looking at sectors, I think we've stepped away a little bit from thinking about styles, continue to really like technology. And that's because those are the companies with the really strong balance sheets, the positive cash flow. And they are withstanding some of those pressures that I think are coming through. So it is a time, we all talk about this from the industry. This really is a time for active management where you're looking at the specific companies and understanding what's going on behind some of those headline numbers.
How do you, when you look at, when you're getting that granular, you've obviously got to kind of think about not only the equity, but also the credit side. What do you think is happening in credit markets? I'm trying to work out which is the most stretched asset right now. And increasingly, it appears to be credit. Govies look stretched. I think a lot of people are talking about that. Equities maybe a little bit less. But credit potentially could be really where the focus should be. When you think about, when you're analyzing companies right now, Seema, if we're doing kind of bottom-up analysis, how much attention are you paying to the credit side of the equation?
You're spot on with this. Credit is the side which I think is most overvalued. It's one of the reasons why we have an equity overweight relative to fixed income. You've got to look at those spreads at relative lows. I mean, some of the numbers on high yield, negative real yields, there has to be some question marks there. So absolutely, credit has to be the focus. If you have any concerns about some of those companies, any concerns about your investment outlook, I think the focus has to be on where is credit and the emphasis on allocation towards equities at this stage.
It's interesting. I want to follow in on that credit markets, because the minute you get a little bit of a widening in spreads, I think it was above, I'm checking my notes here, somewhere above 300, of course, on high yield relative to 88 basis points or so on investment grade, at least within the U.S. when we think about spread over treasuries. The minute you get that widening, you get buyers immediately coming back in. And I am curious, is that FOMO in this market, or is that confirmation of a good global growth underway?
I think it's a reach for yield. You know, everyone is desperate to get something. So as soon as you get, as long as you have a positive view for global growth, for US growth, you therefore don't expect defaults to spike at all. Then anytime that there is a kind of a widening, then maybe you, you do get that surge in demand. But I think that it's those companies that maybe have hidden some of their weaknesses behind a lot of the fiscal health, a lot of the monetary health that's been coming through, that over the coming months, as rates start to go higher, some of those concerns are going to come bubbling to the surface. So that's why investors need to take that little bit of a closer look.
Well, this kind of brings me back to the margin story, because at the moment, everybody's been given a pass. There doesn't seem to be the granularity of analysis at this point on the most stressed companies. And it does seem as if it's the companies that are talking most about input costs that look most exposed to me. Is that the next shift that we're going to see? We are going to start to see a differentiation as we work our way through the earnings season on what companies are saying and what they're delivering in terms of their ability to pass prices on, their ability to manage costs and cope with that input pressure. Because the companies that are probably feeling it the most are probably the companies the most stressed on the credit side too.
Absolutely. Look, the focus has got to be on those margins. Focus, I think, is going to be a lot on supply chains going forward, but that's more of a longer-term theme, because companies have to consider the vulnerabilities within their outlook, where are the margins coming from. You know, we saw guidance, investor focus on guidance on margins in Q2. We're expecting that to become more and more of a theme. And certainly, I think for 2022, that is going to be the key focus for investors.
I've heard a lot of, I guess, conflicting commentary, Seema, and I'm hoping that you can clear up your perspective. Some are saying U.S. versus rest of the world as our strong recovery gets underway. Others are saying EM is really where there's a lot of value to be found, given a vaccine rollout and a global recovery. How are you thinking about U.S. versus rest of the world?
We continue to see a lot of value in the U.S., partly because not only does it have the tech sector, which, as I said before, we do expect to continue to deliver, but it's also got that cyclical side. So if you are hopeful about the global growth recovery continuing, the U.S. provides a bit of both. Now, from a 6-month horizon, however, I think if we're interested in where it's going to be extending that reopening trade that parts of Europe and the US have been enjoying up to now, but is starting to fade, that's where emerging markets can provide those opportunities. The rollout, vaccination rollout is starting to accelerate in some countries, certainly not all, but a lot of them they are, and we should see that confidence returning to both government, to public, to normalize activity in those countries. So we think that over the next 6 months, EM is going to become more and more attractive.
Seema, you and I have gone backwards and forwards over the last kind of few months about whether or not the UK represents value or a value trap. We've just seen the UK government announcing that there's going to be a dividend tax. You're not impressed?
I'm not. I think the UK has enjoyed its time in the sun, but is rapidly coming to an end. We know that most countries at some point are going to have to introduce fiscal tightening after what has been spent in the last 2 years. But the UK is once again the front runner. And on top of that, they're dealing not only with the supply chains that, again, everyone else is dealing with, but they're also dealing with Brexit. The problems that supply chains are weighed under by Brexit. So it seems that the UK is just on a double whammy, which is more than most countries are. So no, I'm definitely not impressed with where the UK is going at this stage.